To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Hi students, in these modules we'll understand about accounting for redemption of preference shares. Now what are preference shares? As you might be already aware, preference shares are those shares which have a priority or which have a preference at the time of payment of dividend and repayment of capital during liquidation or winding up. So when we talk about preference shares, they have a priority or preference over the equity shares or the ordinary shares. So before paying anything to the equity shareholders, either by way of dividend or at the time of winding up when you are repaying the capital, you must first pay the preference shareholders, or you must first pay to the preference shareholder, right? This is what is a preference share. Now in this topic we'll be understanding about what are those regulations and rules relating to redemption of preference shares and how do we do the accounting for that. How to do the issue and how do you account for issue, you would have already learned at the foundation level. Now we are talking about what should be the accounting treatment, how should be the accounting entries when we are actually redeeming those preference shares. Now to give you a perspective, Companies Act does not allow issue of preference shares which are redeemable beyond 20 years. In other words, any preference shares you issue must be redeemed within 20 years. So in India, there is no concept of irredeemable preference shares. Though in theory you may learn it, but practically speaking, there are no irredeemable preference shares. All the preference shares must be redeemed within 20 years. There is a peculiar thing when we talk about redemption of preference shares. Now say ultimately, preference shares are also the owners of the company. Though they do not stay with the company for more than 20 years, they are still categorized as owners, right? Now, if you look at the balance sheet of a company in a T format, on the liabilities side, what all can you see? You can see the equity share capital, you can see the preference share capital, you can see certain general reserves which ultimately belongs to the equity shareholders. Then you can see some liabilities, outside liabilities. They could be secured liabilities, maybe there is a secured loan, or there could be certain unsecured liabilities. These are the broad categorization of things you can see on the liabilities side. On the asset side, you will see a lot of assets. Now, during winding up or during liquidation, when you are actually closing down the company, what will the company do? The company will first realize the assets. You will learn about liquidation in depth when you learn advanced accounting, but for our basic understanding, you will realize or you will sell off all the assets, collect whatever is the cash that is collectible out of that, and then start paying off the liabilities. And friends, there is an order which has to be followed when you repay the liabilities. Whatever you are seeing on the liability side, that is equity, preference, secured liabilities, unsecured liabilities, there is an order prescribed in which these has to be repaid. The first thing that will be repaid out of these four is the secured liability. It could be a secured loan or a secured debenture. So whatever is the security, that will be sold off and that amount will be used to pay off the secured liability. Then you will pay off the unsecured liability. Then you will come to the preference shareholders and lastly you will come to the equity shareholders. I am not talking about statutory dues, workman compensation and all because that will complicate our discussion. You will understand that in detail when you are learning advanced accounting. So out of these four categories, which will be paid first? Secured liabilities, that is the first repayment. Then unsecured, then preference share capital, then equity share capital. Equity will come the last. Now out of these four, number 1 is assigned to secured, number 2 unsecured, number 3 goes to preference, and lastly number 4 is the equity share capital. Now when we are talking about redemption of preference shares, we are talking about a scenario where the company is not being wound up. The company will continue as it is, but we are repaying the preference share capital. What are we doing? We are repaying the preference share capital. Now, if you look at these four people or these four buckets, who should have been ideally repaid first? First repayment should happen to secured, then unsecured, then only you can come to the preference shareholders. But by redeeming preference share capital, what the company is doing is, the company is not paying anything to 1 and 2. The company is directly paying something to number free. Now look at it from the viewpoint of 1 and 2. Don't you think they'll be upset? Don't you think they'll feel unsecured? Because some asset of the company is being utilized to pay off the preference shareholders. See, finally when you are redeeming, you are reducing the liability towards the preference shareholders, and some of the assets, maybe in form of cash or in form of bank, or maybe you would have sold off some investment, you will reduce that asset or you realize that asset and use that asset to pay off these preference shareholders. 1 and 2 will feel unsecured. 1 and 2 will feel, though we were supposed to get the money first, the company is paying off to the preference shareholders. Now this is a situation which can arise. You are giving priority to number 3, ignoring 1 and 2. And they might feel unsecured. It is very natural. They might be sad about it. They might think that the company is cheating on them. So to take care of these issues, what the Companies Act has done is they have made a provision. They have made a provision to protect the interest of 1 and 2. To protect the interest of outsiders, they have made specific provisions in the Companies Act. Now what is that provision? Now if you look at this 1, 2, 3 and 4, you know that 3 and 4 are something which belongs to the owners. 1 and 2 are something which is to the outsiders. So what the Companies Act has said is, if you want to pay something to this preference shareholders, if you are reducing the quantum of preference shareholders, you either bring in fresh equity or you bring in fresh preference share, or out of the reserves, whatever are free reserves which can be paid to the shareholders, block a specified amount out of that. What is the Companies Act saying? Either bring in fresh share capital, means issue new equity shares or issue new preference shares. If you cannot do that, out of the free reserves which is anyways available as payment for dividend, that means free reserves can be used any time to pay dividend to the shareholders. So out of that free reserves, block a specific amount and transfer that to an account called Capital Redemption Reserve. Block that amount in the company itself so that equity shareholders or preference shareholders cannot get any dividend out of that in the future. So what is the Companies Act in effect doing? If you reduce preference shareholders, say by 100 rupees, either add 100 in equity capital or add 100 in preference capital, or out of the free reserves, block 100 rupees and keep within the company. Now once this is done, the owner's position is intact, and the outsiders who have these secured liabilities and unsecured liabilities, they will feel safer. They will not feel cheated, because 100 of preference shares are going out, 100 of new equity shares or preference shares are coming in, or rupees 100 is blocked from the free reserves and kept in a separate account called Capital Redemption Reserve. This is the beauty of redemption of preference shares. How do you protect the interest of others? How do you protect the interest of people who have those outside liabilities? You simply can't say, okay, there is a preference share, I will redeem that. I am giving a priority in repayment. So to ensure that there is enough justice on outside liabilities, Companies Act says either issue new capital or utilize the amount in profit and loss account or in the free reserves and transfer that to Capital Redemption Reserve. Now let us take a couple of scenarios and understand how should the amount be blocked out of the profit and loss account, how are the new shares being issued, and all those aspects. Say there is a company which has preference shares worth of 1000 rupees. What is the preference share value? 1000 rupees. And to redeem those preference shares, the company issued equity share capital of 1000 rupees. What is the equity share capital that is issued now? 1000 rupees. Means there is a fresh issue of shares to redeem the preference shares. Can the company do that? Yes, absolutely the company can do that. Is it required to transfer something out of the profit and loss account and block it as Capital Redemption Reserve? Answer to that is no, because 1000 is what is being redeemed. 1000 is the share capital that has been issued, so there is no need to block any amount in the profit and loss account, right? So it is important to see whether the company has issued fresh shares. Let us take second scenario. The same company, instead of issuing fresh shares and collecting money, it had some investments in shares of some other company. It sold off that shares, collected 1000 rupees, and with that 1000 rupees, it is now redeeming the preference shareholders. Now tell me, is the company required to block something in the profit and loss account? Because you may think the company has actually sold the shares, collected that amount and used it for redemption. Friends, even if the company has sold off the investment, the company must either collect money by issue of share capital, or if it is not able to do that, it has to block the amount in P&L account or in the free reserves and transfer that to the capital redemption reserve. Now in this case, investments are sold, amount is collected, that is perfectly fine. You can use that amount to redeem the preference shares, that is also okay. But because you have not issued fresh shares, you have to transfer 1000 rupees from the profit and loss account and keep it as capital redemption reserve. Are we clear with that? Right. Let's look at the third scenario. Instead of issuing equity shares, the company issued preference shares of 1000 rupees. Now, 1000 rupees of shares have been issued, 1000 rupees of shares will be redeemed. Is there any requirement to transfer amount from P&L to capital redemption? The answer to that is no, because it does not matter. You can issue equity shares, you can issue preference shares. Both of them are acceptable. The only thing is, to the extent you are redeeming the preference shares, you have to issue fresh share capital, or you have to issue fresh shares. Then, instead of issuing preference shares, the company has issued secured debentures. The company has issued secured debentures worth 1000, collected 1000 from debenture holders and repaid these preference shareholders. Now in this scenario, is there a requirement to transfer amount from P&L to CRR? Now generally when we see this term, the company has issued debentures, we may tend to think that because the company has issued fresh debentures, there is no requirement of CRR. Friends, that is an incorrect approach. What should be noted is, you have to issue fresh equity shares. If you are issuing fresh debentures, you cannot count it as equity shares, you cannot count it as owner's capital. So you may issue fresh debentures for your money requirement, but if you have not issued fresh equity or fresh preference shares, what you need to do is, you need to block the amount, you need to transfer 1000 rupees from P&L to CRR. So you may issue debentures or you may sell off the investments. If you have not issued fresh equity or fresh preference, then you are required to block amount in the P&L, transfer that to the capital redemption reserve. Now you may say, sir, what do we do with this capital redemption reserve account? Whenever you are issuing bonus shares, you can utilize this CRR account and issue the bonus shares. So see friends, what's happening? Either you are adding to equity and preference now itself by a fresh issue, or you are blocking an amount as CRR and at a future date maybe you will add it back to the equity share capital. So in a nutshell, whenever a redemption of preference share is happening, option number 1, issue equity shares or preference shares. Option number 2, to the extent you are not able to issue equity shares or preference shares, or if you have not issued any shares at all, transfer the amount from free reserves to the capital redemption reserve. Now let's take a small example, with some numbers. So we have equity share capital of 10,000, we have preference share capital of 5,000, there is a surplus in P&L 7,000, and we have securities premium balance of 5,000. Now the company wants to redeem these preference shares at par, meaning to say you will now need to repay to the preference shareholders rupees 5,000. At par means 5,000 is the face value, 5,000 is the amount at which it will be repaid. Now what are the three things we discussed? Either the company has to make a fresh issue of equity share, meaning to say this 10,000 you have to add 5,000 here, that is one scenario possible. Second, you are reducing preference share capital by 5,000, you can add another new issue by 5,000 here, that is also possible. If you are not able to do this, if you are not able to add equity share capital, or if you are not able to add preference share capital, what you need to do is, from this P&L balance you have to transfer to CRR. What is the amount? Rupees 5,000. You have to transfer to CRR rupees 5,000, and this CRR one fine day can become your bonus shares. Are we clear? Now, can I use the balance in securities premium account and transfer that to CRR? The answer to that is no. Whenever you are transferring to CRR, you should always look at this P&L surplus or any other free reserves that is indicated in the balance sheet. I cannot use securities premium account to create a capital redemption reserve. I hope the point is very much clear. Now let us add one more dimension to this. Let us now assume that the redemption of these preference shares is happening at a premium, meaning to say I am not redeeming them at face value of 5,000. Let's say I am adding 10% premium. I am adding 10% premium. Now, how much is the amount that will be paid to the preference shareholders? You will pay them preference share capital 5,000, premium 10%, which is 500, a total of 5,500, right? That is the amount you will be paying to the preference shareholders. Now the question is, how much should be the equity share I should be issuing? Should I issue equity shares of 5,000 or should I issue equity shares with this 500 at 5,500? Or if I am issuing preference shares, should I issue 5,000 preference shares or should I issue preference shares worth 5,500? If I am creating a capital redemption reserve, should I transfer 5,000 or should I transfer 5,500? This is what we need to understand very carefully, because if it is a simple at par redemption, I am 100% sure you will not find any difficulty. But whenever this premium component comes into play, there could be a chance that you make a small error and you lose out on valuable marks. So listen to this very carefully. How should the adjustment be done whenever shares are being redeemed at premium? Now, I have to provide for redemption of preference capital and also provide for premium on redemption. Now, what can I use or how should I approach? Let us first look at the balances we have. In that, we have one component called securities premium 5,000. Now, where can I use this securities premium? Where should I be able to, as per the Companies Act, for what all purposes can I use this securities premium? That is one thing we need to understand. So let us see where all can we use this securities premium. The first thing where we can use securities premium is to issue bonus shares, right? I can issue bonus shares by using the securities premium. Second thing I can use it is to write off preliminary expenses. The third thing where I can use it is to write off discount on issue of securities or commission paid at the time of issue of securities. The fourth place where I can use it is to provide for premium on redeemable preference shares. And lastly, I can use it to purchase my own shares and securities. Now, when I say I can use it to purchase my own shares and securities, it is called buyback of shares. And again, that you will understand in detail as a part of your advanced accounting. So, these are the 5 things for which I can use this securities premium. Now, this is provided by the Companies Act, or this is given in the Companies Act. Now, if you look at this list, there is one item in this list which says to provide for a premium on redemption of preference shares. I can use it for that. Can I? Yes, but we need to see some other provisions also. Now, out of these 5 things that I have just now listed, what Companies Act prescribes is for those companies where accounting standards have been prescribed under section 133. So, there are a list of companies where accounting standards have to be complied with, and this largely covers almost all the companies. For those companies, option number 2, that is to write off preliminary expenses, and option number 4, that is to provide for premium on redemption. For specified categories of companies where accounting standard is notified under section 133, for those companies, B and D, option number 2 and option number 4 are not available. Meaning to say, a company which is prescribed under section 133 will not be allowed to use securities premium to provide for this premium on redemption. Are we clear with that? So, whenever there is a redemption happening, if it is a notified company or if it is a prescribed company, they cannot use securities premium. And friends, for our examination purpose, for our understanding purpose, we will assume that all the companies that we are dealing with are prescribed under section 133, and hence the company cannot use this particular balance to provide for premium on redemption. I hope we are clear with this. Now, since I cannot use this securities premium, from where should I provide this premium on redemption? See, I am paying out something extra, I am creating a new liability. How should I provide for that liability? To which the Companies Act has a one-line answer, and the answer to that is, so the companies have to use the profit and loss account balance or the free reserves balance to provide for this premium. I hope you are able to understand this. So whenever there is premium on redemption, that has to be provided from the profit and loss account. Now, what is the meaning of provided out of profit and loss account? See, finally premium is paid in cash or through bank, right? Now, how do I provide it out of profit and loss account? Let us pass those entries and understand that. Now, when I have to redeem preference shares, I have to create a liability towards preference share holders. So, what is that liability? I will say preference share capital account debit, because I have to remove preference share capital. I have to remove the capital portion. I have to extinguish that particular liability. I'll debit it by 5,000 and I'll have to credit to preference share holders. How much should the preference shareholders get? 5,000 of capital and 500 of premium. They will get a total of 5,500. Now, what is that balance? That balance is premium on redemption 500. Correct? Premium on redemption 500. Now, this premium on redemption, this has a debit balance. This has a debit balance. If it was not a prescribed company, they could have used securities premium balance to write off this premium on redemption. Meaning to say, you could have debited securities premium, you could have credited premium on redemption, but that is not allowed for prescribed companies. So what should the prescribed companies do? This 500 should come out of this profit and loss balance. What should you do in that case? You will say profit and loss account debit 500 to premium on redemption 500. This is what we mean using profit and loss account to provide for premium on redemption. So whenever there is a premium on redemption, you have to use profit and loss account only. You have to use profit and loss account only. Make a specific note for this. Don't get confused with what you learn in law where they say, okay, as per the fourth option, you can use it for providing for premium on redemption of preference shares. That option is there, but for prescribed companies, that option is not there. And in our exams, in accounting paper, we will be dealing only with the prescribed companies. So where will you provide the premium on redemption out of? You will provide it out of the profit and loss account balance. Now, imagine this particular company has not made any fresh issue of shares. What has it not made? It has not made any fresh issue of shares. So in that case, you will have to transfer an amount to CRR. What should that amount be? Should I transfer 5,000 or 5,500? Now friends, if you carefully observe, this 500 I have already provided it out of the profit and loss account. Correct? The premium on redemption I have already provided it out of profit and loss account balance, which means I am left out with the balance 5,000. Now for that balance 5,000 again, what did we understand? If we are not issuing fresh equity or fresh preference, you have to block an amount in the P&L and transfer that to the CRR. How does that happen? You will pass an entry, P&L account debit 5,000 to CRR account 5,000. Now, if you look at both of these entries carefully, you repaid the preference shareholders by paying them 5,500. For that, you ensure that you blocked 500 here and you blocked 5,000 here. So, you have blocked that portion of the profit and loss account balance which the company could have used to pay dividend. Now, can the company use this 5,500 to pay dividends? Out of this 7,000, 5,500 is blocked or it has been debited. You can no longer use it to pay dividend. That amount remains within the company. So, this amount which would have been paid out as dividend, which the company could have paid back to the shareholders, the company is withholding that amount and keeping it back with itself. So if you keep back 5,500, so you paid to the preference shareholders 5,500, In return for that, you have blocked 5,500, you have withheld 5,500, and hence the outsiders who have the other liabilities, they will not feel insecure because you paid an amount to the preference shareholders, you paid them 5,500. In return for that, you have blocked 5,500 which you could have paid to the equity shareholders. So this is how you should understand. To summarize, if preference shares are being redeemed at premium, what will be the entry for that? You will debit the preference share capital account, you will debit the premium on redemption, and you will credit the preference share holders account. Now what is the amount with which you will credit the preference shareholders? That is the amount of actual redemption. Then this premium on redemption you will transfer to the profit and loss account, and whatever has been redeemed from the preference share capital, the portion of the face value, if you have issued fresh shares, then no problem. If you have not issued fresh shares, then even that will be debited to P&L and transferred to the CRR account. Now let us take another scenario. Let's say we had to redeem this preference share capital and our equity share capital has a face value of 10 each. Now what the company thought, it was commanding a very good market price and it issued equity shares at 20 rupees. At what price? It issued equity shares at rupees 20. Now how much should be the issue? We know we have to pay 5,000 to the preference shareholders. Now should we issue 5,000 divided by 20, that is 5,000 by 20, this makes it 250 shares, or should we issue 5,000 divided by 10 which makes it 500 shares? See, if I issue 250 equity shares, how much will I collect from the equity shareholders? I'll collect 250 at 20, this makes it 5,000. If I issue 500 shares at 20, this makes it 10,000. I am required to issue equity shares to the extent I am redeeming the preference shares. Now the question here is, should I consider the premium amount also when I am issuing the fresh equity shares? That is the question, which means if I include the premium as a part of my fresh issue, I need to issue only 250 shares, but if I don't consider that, I have to issue 500 shares. Now this is one thing which we also need to understand very carefully. Now the 20 rupees issue price has 10 rupees of face value, 10 rupees of premium. And just now we discussed what are the areas where we can use this premium amount, and did we have redemption of preference shares in that list? We did not have, which means I cannot use this premium amount of 10 rupees per share for the purpose of redemption of preference shares. So if I have to figure out how many shares to be issued or what are the number of shares to be issued, I should always consider the face value only, which means I have to issue 500 shares and collect 10,000. In other words, what we need to ensure is the total face value of the preference shares being redeemed must be equal to the face value of the equity shares which has been realized or which has been collected from the investors. So you should consider only the face value and accordingly arrive at the number of shares to be issued. Premium on issue of equity shares should not be utilized for redemption of preference shares, or it should also not be utilized for premium on redemption of preference shares. I hope you are clear with the logic. To summarize, if you have premium on redemption of preference shares, you have to debit that to the profit and loss account. If you collect premium on issue of fresh shares, that has to be ignored and cannot be used for redemption of preference shares. What you need to ensure is the total face value of the preference shares being redeemed must be equal to the face value of the fresh equity or fresh preference issue. If at all there is a shortfall in this, let's say you have face value of 5,000 of preference shares, when you issued equity shares, you collected 3,000 towards the face value. That means there is a shortfall of 2,000. That 2,000 again must be transferred to the CRR from the profit and loss account. This is a summary of whatever we have discussed so far. As we do problems, we'll be able to understand and appreciate the logic better. Now, let us quickly write down entries for all the transactions we have discussed so far, and we'll be good to start with the illustration. Now we said when you have to redeem preference shares, either you will issue shares or you will utilize the P&L balance and transfer it to CRR. Now if you have issued shares, what will be the entry for that? When you issue shares, you will collect money, you will collect amount in your bank account, your bank balance will increase. So if you are issuing equity or preference shares, what will happen? Your bank balance will increase. So you will debit bank account, and what will you credit? Generally you would have credited it to share application, and from share application you would have transferred to share capital. You would have made the allotment entry, you would have made the first call entry, second call entry. All those would not be required here, because generally the entire issue will happen at once. There will be only a single amount that will be collected, and that amount you can directly transfer to the share capital account. So bank account debited with the amount that has been collected to equity share capital account, to equity share capital account. If you have issued preference shares, we will say to preference share capital account. Now these two will go with the face value, these two will go with the face value, and whatever is the securities premium that has been collected, that you will credit to the securities premium account. So to securities premium account, right? So this is the issue price minus face value, right? That is the first entry. Then you will need to pass the entry for redemption. Redemption means nothing but you are cancelling the preference share capital account and you are creating a liability to the preference share holders. So second entry will be redemption. What are we doing? We are creating a liability towards preference share holders. So you will say to preference share holders account. Now this amount should be the preference share capital plus premium. Whatever is the preference share capital plus premium, that is the credit side of the entry. What will you debit? You have to cancel out preference share capital, and that preference share capital has a credit balance. So what will you do? You will debit that particular account. So preference share capital account debit, and if at all there is a premium, so this will go with the face value. If at all there is a premium, you will debit premium on redemption of preference shares. So this will be the premium portion. And what will you do with this premium portion? The premium on redemption of preference shares will be transferred or will be debited to the profit and loss account. So the next entry for that will be P&L account debit to premium on redemption of preference share. So whatever is that premium, with the same amount you will transfer the amount to the profit and loss account. Then are we done with the entries? We are not yet done with the entries. If at all there was no fresh issue of shares, or if there is a shortfall when you have made a fresh issue of shares, you had to redeem shares worth 5,000, you could collect only 3,000. The balance 2,000 should be transferred from the profit and loss account to the capital redemption reserve account. So let's pass an entry for that as well. For creation of CRR, what will be the entry? You will credit capital redemption reserve. What will be the amount for this? CRR amount will be face value of preference share capital that is redeemed minus face value of fresh issue. So whatever is the preference share capital being redeemed minus the face value of fresh issue, that will be transferred to the CRR account. And what will you debit? You will debit your profit and loss account or your free reserves. So you will debit with the same amount and you will create a CRR account. Now friends, we have discussed these three entries or three set of entries. Whenever there is a redemption that is happening, It can be either fully through issue of fresh shares, that is one scenario. It can be without any fresh issue of shares, that is the second scenario. Or sometimes it can be a combination of fresh issue and using part of the P&L balance, right? With this understanding, we'll take a few illustrations and we'll pass the necessary journal entries. Now, finally, you will repay the amount to the preference shareholders. What will be the entry for that? It's a very straightforward entry where you will debit the preference shareholders account and you will credit the bank account. So, write that for payment to preference shareholders. What is the entry? Preference shareholders account debit with whatever is the amount payable to bank whatever is the amount paid, right? With this, we are good to discuss few illustrations. Let us look at an illustration. Hinduja Company Limited had 5,008% redeemable preference shares of rupees 100 each, fully paid up. Now, I want you to pay utmost attention to this word, fully paid up. The reason is, if a preference share is partly paid up, it cannot be redeemed. So, you have to understand, or you have to see in the question and ensure that the shares have been fully paid up or they were made fully paid up, or if nothing is mentioned and you have to make an assumption, please write a suitable note which states that we have assumed that the shares are fully paid up. Okay. Now, reading further, the company decided to redeem these preference shares at par by the issue of sufficient number of equity shares of rupees 10 each, fully paid up at par. So, very simple, you are redeeming the preference shares at par and you are issuing the equity shares also at par. You are required to pass necessary journal entries including cash transactions in the books of the company, right? So, this is a simple question. What is the requirement of the question? You have to pass the journal entries including the cash transactions, and there are two things that are happening here. One, preference shares are being redeemed. To fund that preference shares or to take care of the redemption of preference shares, you are issuing equity shares at par. Now, how do we pass entries for this? First, we need to figure out what is the amount payable on redemption. So, if you look at the question, it has number of preference shares that is given as 5,000, face value 100, premium on redemption nothing, 0. So, you will have to pay 100 rupees for every preference shares to the preference shareholders, right? So, what is the total amount? Total amount payable is 5,000 into 100, that makes it 5 lakhs. Now, this 5 lakhs is entirely towards face value. This 5 lakh is entirely towards face value. Now, you have to ensure that you issue equity shares and collect 5 lakh towards face value. That's the fundamental principle. What do you need to ensure? You issue equity shares and collect 5 lakh towards face value or collect 5 lakh towards equity share capital. So, face value of equity shares is given as rupees 10. How much do I need to collect? I need to collect 5 lakhs. I need to collect 5 lakhs and each share has a face value of 10. So, number of equity shares to be issued is equal to, you need to collect 5 lakhs, this divided by 10 to make it 50,000. Now, what does this mean? To redeem those 5,000 shares, you need to issue 50,000 shares at par, right? Now, once you have this information in hand, passing the journal entries is a matter of simple logic. What is the first journal entry you will pass? You will pass entry for issue of equity shares. issue of equity shares. Now what will happen when you issue equity shares? You will get amount in the bank. So bank account debit, how much? 5 lakh rupees, right? And you will credit equity share capital account by 5 lakhs, right? Narration, don't forget to write, being issue of how many shares? We know it is 50,000 shares. So 50,000 shares at rupees 10 each. Very simple. Now, since you have issued equity shares and collected 5 lakh towards the face value or towards the share capital, do you need to transfer anything to the CRR account? There is no requirement. Always remember what is the face value of redemption versus what is the face value of fresh issue. If both are equal or if the fresh issue is higher, then you don't need to transfer anything to the CRR account. What is the second entry? Second entry is for redemption. So when you redeem, you cancel out the share capital account and you create a liability towards preference shareholders. So to preference shareholders 5 lakhs, and what will you debit? Preference 8%, preference share capital 5 lakhs, right? What is the narration for this? Being amount payable on redemption of preference shares, right? Then finally you will pay the amount to the preference shareholders. The entry for that will be, whenever you are paying an amount to a party, what will be the entry? You will debit that party and you will credit the bank account. So preference shareholders account debit 5 lakhs to bank 5 lakhs. So what is the narration for this? Being amount paid to preference shareholders, right? So with these three entries, your solution is done. Normally you can expect this question for 4 to 5 marks. Now finally you will repay the amount to the preference shareholders. What will be the entry for that? It's a very straightforward entry where you will debit the preference shareholders account and you will credit the bank account. So write that for payment to preference shareholders. What is the entry? Preference shareholders account debit with whatever is the amount payable to bank whatever is the amount paid, right? With this we are good to discuss few illustrations.